Trump called it the biggest tax cut in US history, and technically, he wasn't lying. If you own a business, real estate portfolio, or trust fund, it was like Christmas morning, forever. But if you're a W-2 worker, a nurse, a teacher, a middle manager drowning in student loans, it feels more like a $20 tip slipped into your paycheck by a billionaire on his way to buy another yacht. Sure, your tax bill dropped a little, but theirs dropped permanently, and yours expires in 2025. Cute, right? Because this wasn't a tax cut for everyone. It was a corporate loyalty program wrapped in red, white, and blue branding and sold to you like a discount you never really got. Let's unpack the big, beautiful tax bill and how it made you just a little bit poorer. In late 2017, the Trump administration rolled out what was marketed as a once-in-a-generation tax revolution.
The tax cut bill.
The Tax Cuts and Jobs Act. The headlines practically wrote themselves. Make America healthy again. Lower taxes for everyone. President Trump signed the Tax Cuts and Jobs Act in 2017.
President Trump has just signed the historic $1.5 trillion tax bill, an important moment not only for the administration but also the country. This likely will affect everyone's taxes.
The promise was simple, classic, and patriotic. Lower taxes would put more money in everyone's pocket. Businesses would hire more, pay more, and invest more. Wages would rise. The economy would boom. America would be great again, but this time with a higher paycheck. And to be fair, it sounded good. After all, who doesn't want to pay less in taxes? Especially when everything else, rent, food, healthcare, and student loans keep going up. The bill was branded as tax reform, but really it was tax marketing. A shiny rebrand on a system already written to favor those who understand the code and have the lawyers to navigate it. For everyday Americans, the message was, you're finally getting a break. For businesses and high net worth individuals, the message was something entirely different. This is your golden decade. And oh, by the way, it's permanent. The Tax Cuts and Jobs Act was pitched like a rising tide that would lift all boats. But what no one mentioned was that some boats had engines, and others were handed leaky oars. The idea was economic growth. The reality was a tax code designed to reward ownership, not hard work. So yes, it promised to help everyone. But if you were paying attention, the fine print already showed who the real winners were going to be. So, what did the big beautiful tax bill actually do? Let's peel back the stars and stripes and get to the numbers. First, it slashed the corporate tax rate from 35% to 21%, the lowest since 1939. And that change was permanent, without any expiration or sunset clause, just locked in like a VIP seat for the Fortune 500. This wasn't just for Coca-Cola and Microsoft, it was a windfall for any business that knows how to optimize. And boy, did they. Corporate tax revenue dropped 40% in the first year alone, while stock buybacks skyrocketed to over $583.4 billion in 2018. So much for reinvesting in American workers. Second, it introduced the now famous 199A deduction, aka the 20% off coupon for business owners. If you're an LLC, S-Corp, or real estate investor, you suddenly got a massive tax discount. You could deduct 20% of your qualified business income just because you owned something. This changed the game for landlords, consultants, and anyone who could flip a W-2 into a 1099. Meanwhile, W-2 earners? You got a tiny rate cut and a doubled standard deduction, but only until 2025. After that, it will be gone. The deduction vanishes, but the corporate cuts remain. Cute. Third, they capped the state and local tax deduction at $10,000. This hit upper-middle-class folks in high-tax states like New York, California, and New Jersey the hardest, especially dual-income professionals. You know, the ones who aren't rich, but definitely aren't poor. It quietly yanked away thousands in deductions. In short, if you owned something, a business, property, or intellectual capital, you got rewarded. But if you worked a job and filed a W-2, you got a 5-year trial period. Then the curtain falls. And when it does in 2025, that tax break for the middle class becomes a tax mirage. It's not that the bill did nothing for W-2 earners, it just made sure their win was temporary, while everyone else's was permanent. So, who really cashed in on the bill? First up, business owners. Thanks to the permanent drop in corporate tax and the 20% pass-through deduction, every lawyer, consultant, real estate mogul, and LLC owner got a windfall. In fact, the top 10% of income earners, who mostly own businesses and capital, snagged 80% of the C corporation tax cut benefits. According to Andrea Harrington, the new QBI rules are tax neutral or result in a lower tax bill for my client base, which is predominantly owner-operated businesses. Then there's the real estate crowd. Landlords could write off business income, even if it was just rental cash flow, so property owners started paying tax rates as low as 25%, not 37%. That's not a coding error, that's a tax loophole. The next ones are the high net worth families. They got the capital gains jackpot, step-up basis at death, opportunity zones, and expanded estate exemptions, now $11.2 million per person until 2025. One Wall Street Journal analysis noted that the bill could deliver $41 billion in capital gains savings over the next decade. Meanwhile, according to reports between 2018 and 2022, corporations used the cuts to fund $6.4 trillion in stock buybacks, not new jobs or raises. That cash didn't trickle down. It turned into higher share prices, lining the pockets of shareholders, the wealthy 1%. Tax Foundation analysis projects that after the dust settled, 3.4% higher after-tax income went to the top 1%, while the rest saw much smaller gains. Look at the charts. ProPublica and the Tax Policy Center show middle-income earners, after W-2 adjustments, barely saw 1 to 2% tax relief, while business owners and real estate bigwigs enjoyed permanent multi-digit benefits. In other words, the people who own things, businesses, buildings, and stock walked away with the prize. And the rest got the 5-year trial version, and after 2025, most of the break disappears. This wasn't a middle-class tax cut, it was a wealth transfer coded into law. And it's been working, just not for you. Now, here comes the real kicker, the 2025 bomb. You remember that tiny break you got from the 2017 Tax Cuts and Jobs Act? It's a 5-year trial version, a coupon with an expiration date, and fast forward to July 2025, it blasts. There were press conferences with American flags, hard hats, and assembly line backdrops. Trump himself stood in front of a podium and declared, "This is a big, beautiful tax cut for you all."
This is it's the biggest bill of its kind ever done by far.
That's when your lower individual tax rates, bigger standard deduction, and fatter child tax credit explode off the books. The corporate cuts, still permanent. That 20% business owner deduction stays. That's not an accident, it's built that way. Here's the literal twist. Your tax break had a fuse. Theirs came with a red bow. And guess what happened? Just days ago, yet another version of the crisis tax package was signed into law, vocally dubbed the One Big Beautiful Bill. It permanently extends all the corporate and LLC-friendly components. Hello, cheap business taxes. But guess what passes the expiration date? Your individual tax breaks, now set to vanish in 2025. They extended the state and local tax deduction cap to $40,000, added some quirky carve-outs, but only temporarily for W-2 earners. That means by 2026, millions of Americans could see a significant increase in their tax bills, complete with a rollback of the standard deduction and higher rates. Meanwhile, your friendly corporate overlords just got a permanent gift, cutting their tax burden for good. Analysts estimate these cuts will increase the deficit by $3.3 to $4.6 trillion over 10 years.
A new Congressional Budget Office report projects President Trump's tax and spending law will add more than $3 trillion to the federal deficit over the next decade.
Look, Republicans can use whatever budgetary gimmicks they want to try and make the math work on paper, but you can't paper over the real-life consequences of adding tens of trillions to the debt.
Here's what it looks like practically. You're a nurse, teacher, or engineer. Your rate drops by a point or two for now. But here comes 2026 and the rates head back up. Or you own a business or property. You keep getting a 20% business income deduction forever. Or you pay state and local taxes. You get a temporary relief increase, but after 5 years, back to the old limit, or possibly worse. Political messaging? They sold it as tax relief for all. But the structure reveals the truth. Owners win, workers pay. And the kicker? Even with the deadline closing in, most Americans never noticed the clause that made their breaks temporary, while corporate America celebrated in headlines they weren't reading. So when you uncover that mid-2026 return and see your bill jump, don't blame yourself. This wasn't hidden by accident, it was designed that way. Your tax break had a last call. For them, it has a lifetime pass. If you thought this tax cut helped you, hit like. If you just realized it didn't, hit like harder. So, here's where the trap clicks shut. If you're a W-2 earner, teacher, nurse, or a manager, you're stuck in the middle-class trap. You work paycheck to paycheck, but when it comes to taxes, there's almost no help for you. You don't own a business, so forget Section 199A. You can't deduct half your income just because you structured it a certain way. Instead, you get the standard deduction, which is going to expire this year, by the way. Real estate investors deduct depreciation, shrinking their taxable income while they still earn rental revenue and appreciation. You're paying full price on everything from mortgage interest to your car insurance. Wealthy families split income across trusts, S-corps, and LLCs. They shift profits to lower brackets, to kids, even overseas legally. And you earn, and get taxed. End of story. But here is the big one. The rich legally avoid taxes by owning systems that the bill protects. So, if you want to fix your balance sheet, invest in businesses, buy rental properties, and own intellectual assets, those get special treatment in the tax code. But if you don't own the tools, you're not playing the same game. Meanwhile, as corporate and pass-through tax perks stick around, your temporary W-2 breaks vanish in the rearview by 2026. That means you'll be taxed like it's 2017 again, but without the deductions you once had. Your paycheck doesn't get you access to the tax code's VIP section. Unless you shift from employee to owner of assets, you're playing last year's game with this year's rules, and that court is stacked without telling you. But the good news is that you're not alone. The tax code isn't broken. It's working, just not for you. It was built to reward ownership. It gives power and permanence to those who own businesses, property, or capital, while your paycheck keeps you on the churn wheel. So what now? Here's the play. Stop thinking like an employee. Start thinking like an owner, even if that means creating a side gig as an LLC. Look into tax strategies, depreciation, pass-through deductions, real estate deals, and income splitting. Use your current resources to invest in income-producing assets, not just index funds taxed as income. Understand the code. Laws aren't magic, they're written by lawyers. With knowledge, you can unlock benefits. Prepare for 2026 when your W-2 deductions vanish. Whether you're renting or working, that bill is coming. Because this isn't about being greedy, it's about closing the gap. Until you control systems that the tax code protects, you'll always be paying more than your fair share. What are your thoughts about this big, beautiful tax bill? Drop your thoughts in the comments section below. And if you want more such insights, hit subscribe and start upgrading your ownership mindset.